Dominic Scriven, chairman of Dragon Capital Investment Fund, one of the largest investment funds in the Chinese stock market, once admitted in an interview that despite having over 30 years of battle-hardened experience, he never dares to be certain whether the market will rise or fall the next day. If you are an experienced individual in the financial investment field, you wouldn't be surprised by this statement. Renowned investors worldwide such as Warren Buffett, Ray Dalio, and Charlie Munger have made similar remarks. For seasoned investors, the market is akin to a vibrant young woman. Only fools dare to assert that they fully understand the complete intricacies of a woman's emotions. The desire to predict the future has long been one of humanity's strongest aspirations, which is why we continuously seek information about the future through methods like astrology, tarot card reading, and other forms of divination. Naturally, we feel fear if someone tells us that controlling our own future has never been within our grasp. There is nothing to be ashamed of in this. Indeed, in life, nothing is scarier than an uncertain future. However, learning to confront uncertainty is one of the fundamental yet extremely essential skills in investing. The future will always remain a mysterious variable, and a smart investor understands that life inherently contains unpredictable elements and fully accepts this reality in the market. Investing is not an exact science. Economics and finance have always been fields filled with contradictions. Some knowledge can be effectively applied in practice, such as microeconomics laws related to supply and demand, while other aspects remain purely theoretical. Unlike traditional scientific disciplines, there is no economic rule that can be applied in practice with absolute confidence. To be precise, economics and finance are not pure sciences with highly reliable theoretical models. In physics, we can clearly understand how a mechanical machine operates if we grasp the physical laws governing it, or calculate the motion of celestial bodies in the universe accurately by applying Einstein's theory of general relativity. However, the absolute precision that science offers cannot be achieved in the field of economics and finance, especially in investing, simply because emotions in the market always disrupt rules that seemed immutable in the universe. In investing, all the information we have is usually based on past patterns, both quantitative and qualitative information, but the decisions we make are always oriented toward the future. Investors constantly face a common problem in the market: how to make accurate future decisions based on past information. Although past trends can provide valuable information, seasoned investors also understand an important principle: what has happened in the past does not necessarily have to continue in the future, even if the influencing factors are the same. Patterns that were very useful in the past can suddenly backfire the moment the investor feels most confident. As a famous saying in economics goes, the market never gives you a free lunch. In investing, there is no formula or rule that an investor can be confident will always be effective in the future. At certain times in the market, some investors may discover signals or patterns that predict the future quite accurately and earn substantial profits based on these methods. Over time, the profits they make will undoubtedly attract the market's curiosity. The market always operates as an efficient machine. No superior profit-making method can remain unnoticed for a long period, and sooner or later, any superior earning method will be decoded by other investors in the market. This leads to a situation where more and more people begin to apply these rules with the expectation of the superior returns that the method once produced. Strangely enough, the moment an outstanding investment method becomes popular in the market is also when its superiority disappears. As the author emphasized earlier, an investor's competitive advantage can only come from secrets, the truths that few agree with you. If one day the secret you possess becomes common knowledge that everyone knows, it is no surprise that the advantage it once provided is now just a thing of the past. To understand it correctly, the market is a dynamic environment, not a static one like in the physical world. How do dynamic and static environments differ? To explain in the simplest way, without using too many technical terms, a static environment is one where the governing rules of interactions between individuals, entities in that environment never change over time. whereas changes and evolutionary processes occur in a dynamic environment. A dynamic environment has the ability to change behavior because the components that make up this environment are not inanimate objects, but individuals with the capacity to act independently. In a static environment, rules that were effective in the past will certainly remain effective in the future, whereas in a dynamic environment, there is no certainty whether rules that were useful in the past will continue to be effective in the future. The market is always changing and evolving over time because investors, as individuals with their own will, are also constantly evolving and changing their behaviors to fit the environment they are operating in. The longing to know the future in advance and to completely control one's destiny has always been one of humanity's deepest desires. This is why prophets or priests who worship deities in ancient times held the highest positions of power in primitive societies. They could confidently predict something that would happen to someone, but always remained mysteriously silent when it came to doing the same for themselves. Even though the accuracy of these prophecies was never reliable, our ancestors always held prophets in utmost respect. For us, knowing the future in advance, whether accurate or not, is always better than knowing nothing at all, and those who possess it deserve the pinnacle positions they hold. Rousseau was not exaggerating when he said that for important matters, knowing the future advance certainly falls under important matters. We would rather place misplaced trust than trust nothing at all. This also partly explains why con artists always thrive despite numerous exposes revealing the despicable nature of this class. What they promise inexperienced investors is never profits, but rather the ability to predict the future. Although initially the two seem similar, there is a significant difference in nature. Committing to a future where uncertainty does not exist, a future that can easily manipulate and control, of course, these are nonsensical and baseless claims, is a promise too good to be true for young, inexperienced investors. After stumbling many times in the market, smart investors always understand that if something seems too good to be true, it usually is. Ready-made cheese is only found in a mousetrap. Con artists have always fully exploited this hidden desire of inexperienced investors. A promise of certainty in the future easily turns us into naive fools in the market. Therefore, no matter how many people expose the rotten nature of this class, con artists know they will always thrive as long as new generations of investors continue to participate in the market over time. They will never lack new prey to exploit. The past and the future. Former chairman of General Electric, Ian Wilson, once made a famous statement: "No amount of careful reasoning can change the fact that all the knowledge you have comes from the past, while all decisions are made for the future." You may know exactly what happened in the past, but that does not mean the same must necessarily happen in the future. The market is a complex system with the ability to self-adjust its behavior to fit the surrounding investment environment, and therefore, a smart investor needs to remember that what you know about the past is always likely to be inaccurate in the future, because the market can completely change the rules of the game to adapt to new environmental conditions. The ability to change the rules of the game on its own without any external influence is one of the most intriguing possibilities of the market. It is the factor that creates a dynamic environment that investors always need to be vigilant about if they want to survive in the long term. Reflecting on the ever-present uncertainty in the market, the famous investor Warren Buffett once joked, "Forecasts in the market tell us more about the forecasters than about the future of the market." What he means is that we cannot know anything about the future, but we can know who is playing the fool by trying to convince everyone of the opposite. If a seasoned investor like Warren Buffett or the chairman of Dragon Capital admits defeat in predicting the market, why do others try to do something so futile? Is it possible that everything in the future happens in an unpredictable way? There is a complexity in reality that the author wants to explain here. Warren Buffett was not wrong in his statement, but he also did not describe the full picture comprehensively. In reality, most general events about the macroeconomic landscape often unfold in a somewhat predictable manner. We can predict macro indicators such as GDP growth or inflation rates, within a certain range quite accurately under normal environmental conditions. The author emphasizes range. What we know about the past always carries expectations about the future. We always expect that what has happened in the past will continue to happen in the future. Therefore, most investors' expectations about the market are those that everyone agrees with, and the majority are based on extrapolations from past information provided by the market. This is the biggest problem in investing. The ability to predict accurately will not provide an advantage in investing if others also reach the same conclusions. Accurate information will not bring value to the investor if the entire market agrees with that opinion and thus fully reflects all information into stock prices. Accurate opinions that are unanimously agreed upon are not a form of information that can provide sustainable competitive advantages for investors. As the author emphasized earlier, only secret accurate opinions that few agree with you can give investors the ability to outperform the market in the long term. Therefore, only investors who possess predictions that are not agreed upon by the market, and thus the information has not yet been reflected in stock prices, have the potential to generate extraordinary profits. However, paradoxically, most predictions that go against the market are wrong. Only predictions that are not in consensus with the market open up opportunities for superior returns for investors, but this also means that the error rate of these forecasts increases significantly. Most people who try to go against the market end up looking like fools in the eyes of the majority instead of becoming the next Warren Buffett of the world. But if investors desire a rate of return that exceeds the market, accepting to diverge from the majority is a prerequisite, and of course, this comes with an increased rate of making wrong decisions. This is the paradox of investing. Anyone who has experienced the market for a long time surely understands the author's point. Perhaps we can have a fairly good sense of how the future will unfold under normal environmental conditions where past trends continue into the future. However, we can never truly predict events that, when the future is known in advance, will create a significant difference. When future events occur in a completely different manner from the past and leave a huge impact on society, the financial world often describes them as black swan events. The most fundamental essence of a black swan is its unpredictability, as author Nassim Taleb has repeatedly emphasized in his famous books. Practically speaking, events that create the best profit opportunities, if predicted accurately, are those that are almost impossible to predict, if not entirely useless to attempt such a thing. Most efforts to predict black swan events in the past have only highlighted how difficult they are, with an error rate close to 100%. Most of the time, the future will be a continuation of the past, and thus everyone agrees on future expectations, leading all the above information to be reflected in market prices. In these cases, even if an investor's personal prediction is accurate, it does not create any value because everyone has the same conclusion. However, in a few brief moments, some events occur in a completely different way from what has happened in the past. Sudden black swan events drop from the sky. At this point, accurately predicting these events brings great value to the investor because this information has not yet been reflected in market prices. Unfortunately, black swan events always come unexpectedly, and no one can know them in advance. History has always proven that the greatest investment profit opportunities always come from events that are almost impossible to predict. The author uses the phrase almost impossible to predict because there are a few exceptionally rare individuals who can foresee these events, with the movie The Big Short being a typical example. When the truth changes in a discussion about economic issues, someone criticized the inconsistent arguments of the famous economist John Maynard Keynes. He pointed out that Keynes had said something in economics and then not long after made a completely opposite statement. In response to this criticism, Keynes retorted with one of his most famous quotes, "When the facts change, I change my mind." What do you do, sir, when new information emerges that contradicts your existing beliefs? What will you do? Will you treat it as noise and ignore it? Or will you start to examine whether what you believe is truly the truth? When the truth in your worldview changes, will you change along with the truth? Outstanding investors worldwide, like John Maynard Keynes, are those who are willing to let go of their ego and ready to change their personal opinions if there is enough convincing evidence to prove that what they believe is wrong. This is one of the most important qualities in investing and, in the author's personal opinion, the determining quality of all investors in the world. If an investor does not have the courage to admit to themselves that they are wrong when presented with sufficient information to reach that conclusion, the market will certainly force them to do so, of course, at a very high price. Unlike our parents, the market remains very ruthless to stubborn individuals. To survive in the long term in the market, investors need to understand that the future always contains an unchanging uncertainty. They might have the ability to predict some future events or trends, but it does not change the fact that unpredictable events are the priority issues to be concerned about. Easily predictable events with high probability have never truly provided value in investing. We always underestimate the uncertainty of the future whenever we think about investment decisions. We always think that the future will always unfold as a continuation of the past, a straight line graph connecting the past to the future, thereby underestimating the possibility that the future will present black swan events that can shake the entire market. An open-minded brain that is always ready to accept new information and the ability to resist confirmation bias are essential skills to ensure that what investors believe is always closer to the secret rather than an illusion. Overestimating personal abilities, being delusional about professional expertise, and having excessive confidence to the point of arrogance in one's investment skills are psychological tendencies that smart investors need to avoid. The market is always ready to punish individuals who do not fit the investment environment. Nowhere else do people deluded about themselves learn the important lesson of the value of truth as quickly as in the market. Never be overly confident in yourself. Remember that you can always be wrong. Once again, all the information you know comes from the past, but all decisions are made for the future. There is no certainty that what you knew in the past will continue to be true in the future, and therefore, the future does not necessarily have to be a straight line extending from the past. Investing in an uncertain world has never been an easy task. Investing as if you are certain about what will happen tomorrow is the closest thing to financial suicide. As Mark Twain once said, it's not the things you don't know that get you into trouble, but the things you think you know for sure that just aren't so. Invest as if you are unsure about anything. This will be very difficult for those with a big ego, but it will help you survive in the long term in the market. Between ego and profit, which one do you know you need to choose? After all, you joined the market for that very purpose, didn't you?